All right, so I did receive a request to review Tesla from yesterday's session and specifically how you could have traded it. So for this, I will use the replay function just to give you a bit more accurate representation of real-time trading, without hindsight or reference points. And on my chart, as you can see, I have a candlestick chart, I have Keltner bands, and I do also have a highlight of the expansion bars and potential reversals. And as you can see here, there are two dots, red and green. And this is simply a projection of the average true range multiplied by 2 above and below the current price. And up here, I do have a tool that shows me the amount of shares that I can purchase to maintain an equalized risk per trade, meaning that the position size will depend on my stop placement. So the monetary risk remains similar, meaning a tighter stop will provide more shares and a wider stop will provide less shares. Um, and I will make a video in the future just explaining why, tight stops or narrow stop placement might be problematic. It's usually marketed as a low risk thing, but that's usually not the case. So, but let's focus on the topic itself, which is Tesla. And in this example, I will just use the 5 minute chart just for demonstration purposes. But in real time, you can switch between time frames. You can adjust to the speed of movements if you'd like to. Um, and usually, if I like to take a trade immediately at the open, I will not do so using a naked chart. I will usually reference back a bit using prior sessions or even a higher time frame just to have some reference points. But as I said, in this example, we will use a naked chart and we will trace based off of the structure we are provided. So in this case, market open up, we have this reversal bar outside of the lower boundaries. And if you would like to enter this, taking a risk, well, then you can enter on the break of the highs. And in terms of stop placement, you can use the structure itself, or you can use, as I said, an ATR reference. In this case, a 2 ATR multiplier. So this will make sure you're respecting the prevalent volatility. And especially at the open, things can get a bit crazy sometimes. And in terms of target, same thing here. You can use a visual structure, such as a measured move, the boundaries, prior highs and lows. But here you can also use a fixed risk to reward. And since we're basing our stop based on the ATR, well, our target will also be based off of the ATR. So this makes sure these numbers are not random. It is based off of the prevalent structure in terms of volatility. So in this example, let's say I enter on the break of this high. I put my stop down here somewhere, and then my target 1 ATR above somewhere. And this will make sure that it falls in line with the mean, because usually when we revert, prices tend to converge towards the mean. Not exactly to the mean because it's not an exact point, but towards it of some sort. So let's say in this case, we buy, let's say 267 shares, just because that's what I have on my tool. And then we put a stop loss down here and then our take profit up here, right? And then we play it out and we took some profits around here near the mean, but as you can see, prices pushed even higher. And this is usually not something to be bothered about because timing the top, timing the bottom is usually not a reasonable thing to do. It's very difficult and not necessarily going to lead into a positive expected value over time because you're trading outside of known variables. So if you're chasing outliers, usually your win rate will be a bit lower. But considering things, let's see. Prices continue higher and eventually there is some disruption here. So you're seeing a pullback, right? And this is a good example of a measured pullback. So you make a leg higher, first pullback, second pullback. So it's a measured move, right? So if you want to take a pullback, you can take the break of the highs. But in this case, I'm not going to start taking things randomly. I'm going to look for clear signals of the structure, right? So here we can see I wouldn't say a super clean expansion, but we do have buying coming in. We have a measured pullback. We have a minor expansion near the mean. So this is a reasonable bet to take. So let's say I enter on this formation or on the break of it. I put my stop to ATR below to respect the volatility. The question becomes, what kind of target am I going to look for? Am I going to look for the prior high? I'm going to look for a one-to-one. Um, you can definitely do that as your initial target, but when you have a clear structure in this case, you can also use a measured move, which is a projection of the average volatility. So you're measuring the first leg, the pullback, and then you're getting a projection of the subsequent move. And there's nothing, predictive or magical about this. It's simply a projection of the average volatility. Prices can definitely extend this point and they can definitely fall under this point. So most of these tools, they are just approximations using the prevalent structure, right? So let's say prices move here. We take major part of our profits right here, and then we can trail a portion up to the measured move, right? What happens? As you can see, prices keep pushing, and very strong buying, as you can see. And then eventually you have some form of a disruption here after you have had this measured move play out, right? Um, so usually when you have this type of break, so if you're using, for example, trend lines or channels, and you see a break of them, it usually doesn't mean reversal, right? It can mean reversal, but it usually doesn't. It is just a shift in momentum, right? So usually what happens, it will transition into a range structure or some sort, and then it will usually resolve within time. So just to give you an example here, look around the open right here. So you do have a bullish structure right here. You do have buying coming in, right? Higher highs, higher lows. So we can definitely draw a trend line from the lowest low prior to the highest high as far back as possible without cutting prices. And then when you see the break right here, it doesn't mean reversal. It doesn't mean that the move is over. It simply means that there is a change in momentum, right? So most of the time, as I said, prices will transition into a range structure. And when you have a range structure, being caught in the middle is usually a bit difficult. It can be problematic because there's usually a lot of randomness. What you're interested in when you're trading and what all technical edges come from are imbalances. So imbalances between buying and selling pressure. And that usually occurs as prices tend to move outside of the boundaries, meaning they attempt to break out. So that breakout can fail or it can succeed, right? Um, so that's usually your points where you're probably interested in taking a reasonable bet, right? Um, Anyways, let's go back to our 5 minute chart. And so far we had one trade, two trades. So now let's mark out the prevalent structure here. So this is the current high and this is the current low. Um, let's just see what happens. So as you can see, not much trading opportunities. It was mostly just range movement. Um, and you see, you do have expansions within it happening, every now and then. But taking these type of expansions within a, contractive range is usually a bit difficult, um, especially after you've had such a big move played out. Um, and any form of move outside, as you can see here, will usually try to, fall back inside. So that's kind of how you can streamline things. First and foremost, think about what is the prevalent structure in play. Do we have mostly buying pressure? Do we have mostly selling pressure? Is it balanced? Is it equivalent? So you have more of a range structure, and then you want to locate the boundaries. So prices will never, or I'm not going to say never, but they will rarely move in a straight line. They will tend to oscillate or zigzag towards their predominant direction. And your job is to essentially identify these potential points of imbalances. And whenever prices are at these imbalances, well, then you look for a reaction. So an expansion or a reversal signal in this case. And that's usually your um, trade where you can take a reasonable bet. Um, so in this chart, I would say that we had one, two, maybe three, if you would like to trade here somewhere, opportunities that happened spread throughout the day. And this is something that can be problematic for a lot of day traders, is that you have to kind of be very deliberate. You have to sit, you have to wait, you have to have patience until a good trade shows up, and then you have to kind of execute it perfectly. Um, the risk when you're sitting from open all the way till close is that you're not going to have the patience. You're going to force trades. You're going to overtrade. You're going to see things that are not really there just to get the job done, right? Um, so when a good trade actually shows up, well, then uh, it's very difficult to manage it correctly. So the solution for that, for some people, is to just be more mindful with how you're spending your time, because sitting here from open to close can be very exhausting. It can be very tiring. You're going to lose focus. So one solution is just to spend a limited amount of time in front of the screen. So, for example, just the 2 hour of market open when there is the most liquidity, and maybe revisit towards the close. Or what I like to do is to use alert based trading. So, for example, you can use tools like, uh, let's say, horizontal lines in this case, and you can put an alert on it. So, whenever prices reach these points, well, then you can be alerted and see if you want to evaluate and take a trade, right? Or what I like to do is that I've put alerts on my indicators. So, whenever there's an expansion bar or a reversal candle, I will be alerted, and then I can go to the screen and check if it's relevant or not, right? And usually, most signals will not lead to a trade, but it is just helpful to make sure you're not overdoing things. You're not spending all time in front of the screen forcing trades, right? And this is one of the benefits with, trading view, is that you have all of these benefits of, customization and alerts and stuff like that. And then when you're in a trade, if you feel like you're fiddling too much with the trade, so let's say you enter here and you have a predetermined target up here based on your stop, right? Then if you feel like you're exiting too quickly, whenever it starts fading a bit, you get worried and close the trade. You're over kind of managing things. That can also be a problem. So in that case, it makes sense to use bracket orders. So you get alerted, you enter the trade, you put a bracket stop and a target, and then you leave the screen and let the move play out, right? Sometimes it makes sense to manage it, but other times you have to give it room, you have to give it space. That's just how things are, right? So, anyways, I hope you found this quick review helpful. And if you're interested, I will do more videos like this, and I can do special requests on specific tickers or specific days or time frames or whatever it might be, right? I'm just happy to help. And as I said, I will make a few more in-depth posts, for example, about stop placement and the problem with tight stops. I will also talk a little bit about the problem with, fading, and what kind of mindset you need to have when you're fading, and counter trend trading at times. So hopefully you will find that helpful. And if there is anything, just let me know. I'll try to help.